Imagine a journey from dazzling success to shocking failure. Some of Africa's brightest startups, once poised to transform the continent, stumbled in ways no one saw coming. In this video, we're diving deep into the world of African startups that went from boom to bust, dissecting what went wrong, the hard lessons learned, and what every aspiring entrepreneur can take away from their stories. Let's uncover the truth behind these epic falls. Quibi's journey was a masterclass in how market timing can make or break a startup. With a staggering $1.75 billion in funding, Quibi aimed to revolutionize mobile entertainment through short-form videos, each around 10 minutes, designed for those moments in transit or during a brief break. However, the timing of its launch in April 2020 could not have been more unfortunate. The global lockdown due to the COVID-19 pandemic was in full swing, urging people to stay home, which directly contradicted Quibi's on-the-go viewing premise. The marketing strategy focused heavily on traditional media like TV ads during high-profile events like the Super Bowl, spending $40.8 million in the first half of 2020 alone. This was misaligned with the digital native audience Quibi intended to capture, most of whom were already engaging with content via social media platforms like TikTok or YouTube. Furthermore, Quibi's app lacked crucial features for the new normal, such as offline viewing capabilities or robust social sharing, which could have fostered organic growth through viral content. The platform's technology, named Turnstile, allowed switching between portrait and landscape modes, but this wasn't enough to compensate for the lack of alignment with consumer behavior during the lockdown. From a tech perspective, this highlights a broader lesson on product-market fit. Even with innovative technology and substantial financial backing, if the product doesn't match the current needs or behaviors of the market, it's set up for failure. Quibi's executives, while experienced and successful in their previous ventures, perhaps underestimated the agility required in the tech startup world, where adaptability to unforeseen global events like a pandemic is crucial. This case serves as a reminder that in tech, understanding and predicting user behavior, especially in rapidly changing environments, is as critical as the technology itself. HouseMe, a South African prop-tech startup, set out to streamline the rental process through automation. The concept was timely, aiming to reduce the friction in property management through technology. However, the economic fallout from the COVID-19 crisis presented an unexpected storm. The startup's business model, while innovative, was highly dependent on venture capital, which became scarce as economic uncertainty rose. The tech industry often sees startups that pivot or innovate their way through economic downturns, but HouseMe's inability to pivot or secure emergency funding was telling. This failure underscores the importance of financial resilience in tech startups. From a tech expert's viewpoint, the lesson here is multifaceted. Diversification of funding. Startups should not rely solely on venture capital. Exploring alternative revenue streams, such as subscription models, partnerships, or even government grants in response to crises, could provide a buffer. Operational flexibility. In real estate tech, where operational costs can be high due to physical assets or the need for customer support infrastructure, startups need to design their operations to be scalable down as well as up. This might mean developing technology that can function with minimal human intervention or finding ways to reduce burn rate without compromising service quality. Market sensitivity. Understanding that the tech you develop must be responsive to market conditions is crucial. HouseMe's automation could have been adapted to serve new needs emerging from the crisis, like virtual property tours or contactless rental agreements, potentially opening new revenue avenues or at least providing a lifeline until normalcy returned. HouseMe's story is a stark reminder that in the tech world, where innovation often outpaces traditional business models, the ability to adapt financially and operationally is as important as the innovation itself. Tech startups must build their financial models with resilience in mind, anticipating both growth and the need for contraction in times of crisis. 54Gene, founded with the noble intent of advancing genomic research in Africa, initially seemed like a beacon of innovation. The company aimed to sequence African genomes, an underrepresented area in global genetic studies, to enhance medical research and personalized medicine. However, its journey was marred by governance issues that ultimately led to its closure. From the outset, 54Gene had the potential to revolutionize healthcare with its focus on African genetics. It attracted significant investment and attention due to its unique approach. However, the narrative took a dark turn when the company faced internal challenges. Leadership turmoil became evident when its founder, Abasai Inabong, was ousted as CEO in early 2021. This was followed by allegations of misconduct, including intellectual property disputes and financial mismanagement. These issues not only highlighted a lack of transparency, but also brought to light how quickly trust can erode when governance falters. The tech world, particularly in biotech, where trust and ethical considerations are paramount, requires a robust framework of corporate governance. 54Gene's failure in this aspect serves as a stark lesson. The company's rapid scaling and the pressure to innovate might have overshadowed the need for solid governance structures. Here are some key insights from their experience. Transparency and accountability. Any startup, especially in sensitive fields like genomics, must maintain high levels of transparency with stakeholders. The lack thereof can lead to distrust, legal battles, and ultimately, the company's downfall. Ethical leadership. The importance of ethical leadership cannot be overstated. The controversies surrounding 54Gene underscore how vital it is for founders and leaders to embody the values they promote, both in public and behind closed doors. Governance from the ground up. Startups often focus on growth and innovation, sometimes at the expense of governance. 54Gene's story shows that integrating good governance practices from the beginning is crucial, not just for compliance, but for the long-term health of the company. Stakeholder trust. In fields like biotechnology, the trust of stakeholders, from investors to the scientific community, is the currency of operation. Losing this trust can be terminal for a business. The fallout from 54Gene's governance issues was not just financial. It was also a blow to the broader ambition of African genomics research. The lesson here is clear. While technological innovation is vital, it must be paired with an equally strong commitment to ethical practices and governance. Without this balance, even the most promising ventures can unravel, leaving behind a legacy of what could have been. Qubits' venture into the blockchain and cryptocurrency space was both ambitious and fraught with challenges. Launched with the intent to provide a robust platform for cryptocurrency trading in Africa, QubitX aimed to tap into a market that was both emerging and volatile. Here's an in-depth look at what went wrong and the lessons we can learn. Technical deficiencies. At its core, QubitX suffered from a lack of deep technical expertise among its founding team. Cryptocurrency exchanges require not only a solid understanding of blockchain technology, but also sophisticated security measures to protect against hacks and fraud. The platform experienced issues with transaction speeds, downtime, and security vulnerabilities, which are critical failures in the crypto trading world where trust and efficiency are paramount. This underscores the lesson that technical expertise is non-negotiable in tech-driven fields like blockchain. Financial mismanagement. QubitX also faced issues with its funding strategy. The startup spent heavily on marketing and user acquisition, perhaps in an attempt to quickly establish itself in a competitive market. However, this aggressive spending was not matched with a corresponding increase in technical development or operational stability. The financial model lacked the necessary prudence to sustain the business through the ups and downs of the crypto market. This serves as a reminder that financial management in startups, particularly in high-risk sectors like crypto, must be meticulously planned to ensure sustainability. Regulatory navigation. Operating in Africa, QubitX encountered various regulatory landscapes across different countries. The crypto industry is particularly sensitive to regulation due to its association with financial crimes. Qubits' failure to effectively navigate or even anticipate these regulatory challenges led to operational hiccups and lost opportunities. This highlights the importance of understanding and complying with local regulations, which can vary significantly by region. Market misalignment. While the idea of bringing crypto trading to Africa was innovative, QubitX perhaps did not fully understand the market it aimed to serve. The adoption of cryptocurrencies in Africa can be influenced by different factors than in more developed markets, such as the need for cross-border payment solutions or remittances. Their product did not sufficiently cater to these unique needs, illustrating that a deep understanding of your target market is crucial for product-market fit. Community trust. Trust is the bedrock of any cryptocurrency platform. KuBitX failed to build a strong community around its services. User engagement was low, and there were not enough incentives or educational resources provided to grow a loyal user base. In the crypto world, where community often drives the success of a platform, this was a critical oversight. Building and maintaining trust with your user base is not just about security, but also about fostering a community. In summary, KuBit's downfall was not due to a single issue, but a confluence of technical, financial, regulatory, and market fit problems. The lessons from KuBitX are clear. Ensure your team has the necessary technical chops, particularly in areas like blockchain, where technical execution is key. Manage your finances with an eye on long-term sustainability rather than short-term growth spurts. Navigate the legal landscape with foresight and agility. Understand and serve your market's unique needs, not just the general trends. Lastly, build a community around your product that believes in your vision and trusts your execution. This story from the African startup scene serves as a case study in the complexities of entering and sustaining a business in the fast-evolving crypto market. Thanks for watching. If you found these startup stories insightful, make sure to hit that like button, follow and subscribe for more deep dives into the world of business. Remember, failure isn't the end. It's just a stepping stone on the journey to success. Drop a comment below on which startup story surprised you the most, and let's keep the conversation going. Until next time, keep learning, keep building, and keep dreaming big.